So this new client calls me, or I should say, potential new client calls me yesterday, and we're talking about his an investment in a RM Crow property. I think it's Bedford and Ridgelea or something like that. I don't even know how to pronounce it. It's two properties, and he's talking and he's going, Ray, it's just not fair. Here I am. When the property was performing, I was collecting about 25,000 a year in distributions, but I was paying tax on 75,000, and that's just not right. All the money that was getting distributed to me was going to taxes, and I said, it just doesn't seem right to me either. And so we talked a little bit more, and I remembered that I had another client in that property, and I looked her up and I asked this new client, how much he invested in the property. Turns out they'd invested about the same amount. And this is what's so really wonderful about working with so many TIC investors is not every property, of course, but I have data on 400 or 500 different TIC properties. So if you call up, there's a good chance that I'll know something about your property. And in this case, I looked at uh, my other client, and the distribution she was getting were about equal to her taxable income. So I talked to this potential new client a little bit more, and here's the difference. First of all, and I have to get his return to know this for sure. He's mailing it to me now, but I think that his current preparer didn't know how to figure the new basis and the depreciation on the property, so he's probably losing a lot of depreciation deductions. But even more important is the repairs that were done on the property. And this is another case where if you don't understand uh, what is going on in the world of TICs, you'll never get this. Here's what happens. A sponsor is managing a property for you, and they want that property to look good. They want you to think it's performing good. Well, hopefully it is performing good, but they want it to look as good as it can. So, uh, if you had, say, an apartment and a tenant moved out, why you'd go in and paint that apartment and put in new carpet. And if your guy preparing your tax returns knows anything, he'd call those expensive repairs, and that would be true. But a sponsor, if he calls them repairs, they decrease the bottom line. They don't look that like to make that property look so good. So what they'll do is they'll say they're a capital improvement because capital improvements get depreciated over several years, and so they don't affect the bottom line of the property so much. And in fact, most cases they don't affect it at all because the sponsor doesn't even show the depreciation from those capital improvements on the profit and loss statement. So by moving it from repairs to um, capital improvements, they make the bottom line look a lot better. And the most extreme example of this I found was a client that on their capital improvement um, page that they got from the sponsor, it had an entry for business cards and stationery of something like $3.78 that the sponsor was suggesting that they should depreciate over 7 years, I believe it was. That's just crazy. That's even crazier than depreciating new carpet in an apartment. So in most cases, these items that the sponsor, and I don't mean to denigrate the sponsors, to depreciate those items. And I have to say I'm more of a tax guy than an accounting guy, but But in most cases, the way they're doing that, there's nothing in accounting rules that say they shouldn't show you a profit and loss statement and have things on a capital improvement schedule. It makes sense for accounting. But what's the definition of a capital improvement for tax purposes? The definition is capital improvement either increases the value of the asset or extends the useful life. And I'll guarantee you, most of the things that are done and called capital improvements, they do not extend the life of the building, and they don't make the building worth any more at all. They're just cosmetic things that keep the building operating. And those things that just keep it operating in normal conditions, that's the definition of a repair. But what happens is your tax guy, he gets that information. He sees it's being depreciated. He thinks, capital improvement, I better depreciate it because that's what these guys did on their accounting statement. He doesn't understand the psychology of that the sponsors are trying to use to make you think the property is performing better than it is. And he doesn't understand the difference between that and the taxes. So he puts it on as a depreciation schedule. Now, in the client, the potential new client that called me, I think the clients for that mistake, probably over the last 5 years, they paid about $25,000 more in taxes than they needed to. Now we're going to go back and recover a bunch of that, hopefully a lot of it, but it just goes to point out that a tax preparer, no matter how nice they are and how long you've known them and how good they are, it's not the same as having a tax professional that understands TIC investments. Totally different. And judging by the returns I've reviewed, and I've reviewed a lot of them, in somewhere between 70 and 80% of the cases, using a tax preparer that understands, that doesn't understand TICs, costs the taxpayer money. You really need, when you get into TICs, you need to have somebody doing your taxes that really understands the TIC market. Everybody's got questions about income taxes and about finances, and I have answers. Thanks for listening.